I want to do something a bit tricksy. We often will have talked a lot on this pod about froth in the market. Are we top of the market? Is this the .com? Is there a story to be told here? So what I've done is I've put 10 reasons why it is 1999. So I've tried to put what I think are the top 10 reasons. Yes, it is. It's frothy. We're in trouble. This is, super crazy bubble territory. I've also written no, it's not. And I've done 10 for a yes and a 10 for no. So what I'm going to do is very, very quickly give you both the 10 yeses. And then I'd like you both to chime in on each of the elemental points as to what you agree with, disagree with, and unpack things that maybe aren't so common in the public discourse. And then we'll do the same for the no's. So on the yeses, it is 1999. This is top of the market. It's froth. It's crazy bubble territory. So the Shiller index just flashed red. The CAPE ratio, the price to earnings ratio, has just crossed 40 for only the second time in history. Last time was in December 1999, just before the Nasdaq lost 78% of its value. A leaked draft this week from the Treasury likens AI to the .com bubble. So the powers that be are talking about this. Money is chasing its own tail. This is number 3. Over 800 billion of AI deals are now circular, e.g. NVIDIA puts 100 billion into OpenAI. OpenAI fills its data centers with NVIDIA chips. Or central banks are saying it. Taiwan Central Bank, BOE, even the BIS warned in late June that the bubble could pop and take the global economy with it. Concentration looks the same as the .com. AI Big 10 are now 40% of the S&P. The CapEx metric is already past 2000. CapEx to sales hit 32% at the .com peak. AI is projected to hit 34% this year. Burn rate. OpenAI is reportedly losing 12 billion a quarter, on track for 14 billion this year, against roughly 1.4 trillion in data center commits. Debt has now entered the story. Big tech is no longer the cash machine. Lending is happening. OpenAI borrowing $520 million. Hyperscalers now carrying $1 trillion in undisclosed data center leases. The cracks are showing. NVIDIA shed almost $1 trillion in under 2 months. Oracle, the most exposed hyperscaler, is down 40% in a month. And finally, the silly money is moving in. Blue Origin, maybe you've seen this, now raising 10 billion at 130. So they are my 10 top reasons for yes, it's crazy town. It is 1999. The bubble is going to pop. Mads, what do you say to the 10 yeses?
Can make lots of arguments on either side.
You politician, you, I love you.
Well, I mean, look, economists have predicted 9 of the last 5 recessions, right? There are always lots of reasons why stuff isn't going to work. And I think trying to predict the top of the market is a little bit of a fool's errand. I don't know if anybody can ever truly do that, because booms that can turn into bubbles often have a lot longer to run than people think. Now, it's interesting that the BIS, kind of the Bank of International Settlements, they are talking about this being a bubble and a mania. They're talking about the canal mania, the railway mania, the .com, kind of all these infrastructure manias that always work out in the same way every time, which is they drive a lot of capital into infrastructure. And the people that fund that capital, that provide the capital and build out all the infrastructure, they end up losing their shirt. But the world at large that ends up with a lot of infrastructure that's built out and benefits the economy and drives growth in the years after that. And so,
just to qualify, Mads, just for those that don't know, the BIS, because I didn't know it until researching this segment. The BIS is like the central banks of central banks, a Swiss-based organization. Is that fair? Yeah, okay. So if you didn't know, that's what the BIS was. I had to look that up. So the BIS is like the big daddy to all the central banks.
And look, we're seeing some crazy town things happening. So SK Hynix, they've IPO'd now, right, in the US via the ADRs. And what is an ADR? Well, it's a way for a company that's listed somewhere else in the world to also list in the US and be traded in the US. And immediately following the listing, an ETF arrives that allows retail investors to invest in SK Hynix on a 2x leverage. it's bubble stuff. I mean, you can't get around that.
Yeah,
and these companies are seesawing up and down. Even Samsung, which is a formidable company, I think is sometimes swinging more than 5% a day. Right, for a company that size, it just sort of tells you something about how volatile the market is. At the same time, we know that AI is world transformative. We see it every day. We see revenue growing for these companies. There is going to be a lot of value still to come, and yes, there is some concerns around whether SK Hynix and Micron and Samsung on the memory side can keep up the formidable growth and profitability they have, but I don't think anybody really expects sales to slow down this side of 2028. So all we're discussing is at some point in the next few years, growth is going to stall. Nobody I think, is suggesting that revenue will totally collapse. So you could argue it either way. I think if I was going to go back to some of the stuff we talked about last year, yes, this is certainly boom territory. Some of the stuff looks very bubblish. The opportunities are very real. And I think what will come out of it is there's going to be a painful consolidation across some of these things. We discussed some of it earlier in the pod. What is going to happen to the frontier labs? Can they keep climbing up the value stack into applications and take enough value there that they can create enough of a moat that they won't be displaced by commoditizing foundation models? And then, of course, you've got the hyperscalers that are doing, all the CapEx build out and now started to go from kind of funding that with free cash flows to funding it with debt to actually now issuing equity. I mean, can you believe Google issuing shares? The company were printing so much money, they've never found a way to spend it. Now they're issuing equity.
Bonds,
but bonds is one thing, right? But issuing equity for a company like that is just not something you thought you'd see. We're seeing lots of retail activity. Kind of this that tell, right? Kind of the fourth horseman of the apocalypse of an impending doom is kind of when you see retail piling
comes.
in, when you see corporates selling their equity, right? I mean, those are kind of two of the key ones. So there could be lots of arguments why this is the top. The market will top at some point. Okay, nothing keeps going up forever. I just don't think we know for sure whether it's this summer or Q3 or Q4 or Q1 or exactly when it happens. Who knows?
Lomax, it is 1999. Go.
Well, I think so. I'm just picking up on a few things that you said. First of all, the central banks. I mean, it's kind of in their job description to be harbingers of doom, or at least to hold everyone
harbingers of calm.
Yeah, harbingers of calm. At least rein everyone in a little bit and get everyone a little bit back over their skis. So, even if you look back in the 90s, Greenspan was warning against irrational exuberance in 1996, right? So he was, 3 years early. If you look at, there's some things that are interesting to look at when you are drawing the comparison. The problem is comparisons only work to a certain extent, right? It's useful, it's informative, but clearly what has happened and what will happen will unfold very, very differently. So we should be careful about leaning too heavily into the analogy. But, Nasdaq is up 115% since ChatGPT. Actually, post-Netscape in the 90s, Nasdaq was up 700%. So the kind of the growth, yes, we've seen huge growth, but nowhere near what we saw in the 90s. And then, I think the biggest thing to worry about is which is similar to last time, is that you end up with a lot of extreme amount of CapEx, which cannot just be justified. Here, of course, we do have real revenues underpinning many of these companies, unlike, pets.com, Webvan, etc. back in the day. However, the sheer ratio of CapEx to revenue is a little bit off kilter now. If we're talking about $70 to $80 billion of AI revenue at the moment, depending on how you define it, with trillions of CapEx going into the ground, that growth rate has got to carry on pretty steeply to justify the CapEx against the backdrop of commoditization of the models. That is something that could leave us on a bit of a sticky wicket.
Let's get into
our Anthropic bills have started increasing so much now that we are starting to look at whether we can switch more workload off to other models or onto open source. And look, the truth is the model is one thing, but the scaffolding, the Claude code, all the harnesses, all the stuff that sits around, that's really where you get some of the lock-in. Because once you've got your whole setup, you're just not likely to switch out of it. And so I think it's stickier than just the raw model performance would have you believe.
But that sounds like an opportunity for some smart founders, though, Matt.
Yeah, I think it's a fairly battled over battleground, if you will. What's the open gap in that particular market today somebody would go after? I don't know. Anything top of mind for you?
No, I think as we see with all great things, especially in software, you see this kind of great bundling, this great unbundling, then you see this aggregation, then this disaggregation. So I think there is going to be, as the commoditization becomes more known, integrated, available, and then you're going to get these great tools, which, like you say, are already out there that are enabling a little bit of this on-prem, a little bit of this super-duper Anthropic this, a little bit of this OpenAI super-duper that, a little bit of this Quen or whatever it might be. So I think we're going to see this kind of blended approach, which I think will, obviously, for us, would ease the monthly costs. And I think that's where enterprise is going to end up. They're going to end up in this kind of slightly more blended approach. But I do sound like a broken record on that one. Let's move on to the no's. This is the no, it's not 1999 top 10. The technology already works. We've talked about this. In the .com, there was a lot of nonsense. The tech is working. We can see it. The leaders are the most profitable companies in history. And up until recently, the Microsoft, the Alphabets, the Metas, the Amazons, they've all been paying for the build-out free cash flow. Real usage, not eyeballs. In 99, the metric was page views that never really did anything. We're already seeing trillions of tokens per week in usage. Valuations, I think to your point, Lomax valuations are less than half the .com peak. The Nasdaq forward earnings multiple around 23 to 24x today versus 60 to 70x in March 2000. Fastest revenue ramps ever built. We're looking at 20 billion ARR from OpenAI. Anthropic through past 9 billion, scaling in 3 years, what Amazon took a decade to reach. Demand is already physically constrained, so classically bubbles are not that. They're infinite hype, chasing infinite supply. We have some limits in the box. They've got a chunk of demand that can't leave, so we're seeing governments now treat compute as national infrastructure, so there's a solid base to this. Even the bears concede the fundamentals. Leaked Treasury report also admits today that AI firms are more mature, profitable, and better capitalized than their 90s peers or reflections. Retail isn't really holding the bag just yet. There are fewer small investors that are directly exposed. And last on the list, even if, maybe to your point, Mads, even if we do overbuild on the CapEx front, it won't be wasted. The .com fiber glut took years to reach its usage, but this is going to be used almost instantaneously. So they were my top 10 for it's not 1999. Now, Mads, you've answered a lot of these already, but any closing points or any conclusions before I hand over to Lomax?
But I think, just taking the flip side of your last flip side, which is that CapEx is being built out, and in the .com boom, that was useful in the years that followed. I mean, that was what happened in 1999, right? And there's an argument that this could happen again. The main difference between now and 1999 is that today, the technology is being used and is useful and generating more revenue much earlier in the cycle. In 1999, we had a big build out that was being used to generate eyeball metrics. Today, it's being used to generate revenue. May not be profitable revenue yet, but it's real money, and revenue growth rates are formidable. Huge difference.
At a being mic drop. Lomax, anything on the nose?
No, I think what Mad said, nothing to add from what I said earlier.